Build your dreams, live rich, and leave rich.
Welcome. Today, we're not just going to discuss another investment strategy. No, we're going to dismantle the single biggest piece of advice you've ever been given about the stock market. We're going to challenge a belief so fundamental, it's pretty much the golden rule of investing. So get ready, because we're about to look at Dalal Street from a completely different and way more aggressive point of view. You've heard this 1,000 times, right? From your parents, from so-called financial gurus, on TV, everywhere. It's the oldest mantra in the book. Buy low, sell high. And you know what? It makes sense. It feels intuitive. It feels safe. It's the foundation of almost everything we're taught about investing.
But what if I told you that some of the most successful, most aggressive strategies on Dalal Street are built on the exact opposite idea? A strategy that actually tells you to buy what's already expensive and then sell it when it gets even more expensive. I know, it sounds completely insane, but this is the core of one of the most powerful forces in the market. Let's break it down. Now, to be fair, the buy low, sell high strategy has its place. Of course it does. It's the logic behind really powerful tools like systematic investment plans, or SIPs. The whole idea is to use something called rupee cost averaging to your advantage, basically turning all that market chaos from your enemy into your friend. So here's how it works. It's actually pretty simple. You invest a fixed amount of money, let's say 500 rupees, every single month. Now, when the market is down and prices are cheap, your 500 bucks buys you more units of a fund. And when the market is flying high, that same 500 rupees gets you fewer units, you see? Over time, this all averages out your purchase cost, and it forces you to invest with discipline no matter what drama is happening in the market. But here's the thing. While that safe and steady approach works, there's another way, a much more radical idea. It's called momentum investing. And this philosophy, it isn't about finding a bargain, not at all. It's about finding the fastest, most powerful trend in the market and just riding that wave for as long as you possibly can. The analogy is simple. You don't look for a slow train, you jump on the express.
Let me paint a picture for you. A traditional value investor, they're looking for a cheap, rusty, broken-down train sitting at the station. They buy a ticket, hoping that someday a mechanic shows up and fixes it. A momentum investor, they do the exact opposite. They ignore those cheap, broken trains. They stand on the platform and look for the one that's already blasting past them at 200 kilometers per hour. They don't care that it's already moving fast. In fact, that's precisely why they want it. Their only goal is to jump on and ride its pure, raw speed.
Okay, so if you're jumping on the fastest train, how do you even know which one it is? For that, we need another analogy. So forget the train for a second, and I want you to imagine the most ruthless, unemotional cricket coach you can think of. A coach who has one rule, and one rule only, and it is brutal. Look, this coach's rulebook is brutally simple. He does not care about your past reputation. He doesn't care if you're a legend like Virat Kohli. If you don't score runs for a couple of matches, you're out, dropped from the team, instantly, no second chances. On the other hand, if some unknown 19-year-old from a small town just hit a century, he's on the team, immediately. There's no emotion, no favorites. There's only one thing that matters: pure, current, undeniable performance. And that is exactly how a momentum strategy picks its stocks.
So, this speeding train, this ruthless coach, these are powerful ways to think about it. But at the end of the day, who is this coach? Well, it's not a person. The ruthless coach is a computer. It's an unfeeling algorithm that follows a brutally simple set of rules with perfect discipline day in and day out. So let's look at how this robot actually works.
So what is momentum investing, really? At its heart, it's basically a law of physics applied to the markets. An object in motion tends to stay in motion. The whole strategy is built on the assumption that stocks that have been doing really well recently will probably continue to do well in the near future. You're just making a bet on a trend continuing. All right, let's get into the nitty-gritty. How does this robot coach actually build its team? Say for the Nifty 200 Momentum 30 Index. It's a 4-step process, and it's completely automated. Step 1. Scan the universe. The computer looks at the 200 largest companies in India. Step 2. Rank by speed. It then ranks every single one of those companies based on their price performance over the last 6 and 12 months. Step 3. Select the elite. It brutally, without any emotion, picks only the top 30 performers from that list. And finally, the most important step. Rebalance. Every so often, the computer runs this whole process again, ruthlessly kicking out any stock that's lost its speed and replacing it with a new winner. That's the ruthless coach in action.
Okay, so far, this all sounds incredible, right? Just buy the winners. But Riding the fastest train comes with a massive, massive risk. What happens when that speeding train doesn't just slow down, but it hits a brick wall? This is the double-edged sword of momentum, and you absolutely have to understand this part.
I want you to think back to March 2020. Remember that feeling? When the COVID pandemic had just started and there was just absolute panic in the markets. People were seriously wondering if the world itself was coming to an end. Well, in a crash like that, the fastest moving stocks, the ones a momentum strategy loves, are often the ones that fall the hardest and the fastest. Because they fly so high, they have the furthest to fall.
And that brings us to the biggest risk of all with this strategy, volatility. Volatility is just a fancy word for how often and how dramatically a stock's price swings up and down. And these high-flying momentum stocks are, by their very nature, extremely volatile. The same rocket fuel that sends them soaring upwards can also send them crashing down just as quickly.
And it's not just about the big crashes. There's another, sneakier risk. It's what happens when the market has no clear direction, when it's just choppy and moving sideways. See, momentum needs a strong trend to work. In a sideways market, the computer can get tricked or whipsawed. It buys a stock right after a little jump just before it falls. Then it sells after the fall just before it rises again. It's a brutal cycle of buying high and selling low, basically an investor's worst nightmare.
So, with all these risks and the sheer complexity of buying and selling all the time, you might be thinking, how could a normal person even do this? Well, the truth is, trying to do it yourself is a complete nightmare. And that's exactly where the index fund comes in as this elegant and powerful solution. Let's see why.
Look, if you even tried to run this strategy on your own, you'd run into 3 huge roadblocks. First, taxes. You're constantly selling, so you'd get hit with massive short-term capital gains taxes. Second, costs. You'd be paying brokerage fees and transaction taxes on every single trade, and that just eats up your returns. And third, the sheer effort. It requires constant, unemotional work. But inside a mutual fund, all of that buying and selling is done for you by the fund manager. The costs are all bundled into one tiny expense ratio. And, most importantly, the tax gets deferred. You only pay tax when you finally sell your units years down the line.
And that really brings us back to that simple idea, the bus ride. If trying to do this yourself is like riding a risky motorbike, then a mutual fund is like taking a reliable bus. You don't have to worry about driving, you just buy a ticket, take a seat, and let a professional driver, the fund manager, navigate all the complicated roads for you. They handle the rebalancing, the costs, the taxes, the whole shebang. For a complex strategy like momentum, it's the smartest way to travel.
All right, we have covered a ton of ground, and we've used some pretty specific words. So before we finish up, let's just do a quick jargon buster, just to make sure the 4 most important ideas are totally locked in. First up, momentum investing. It's simply a strategy that buys things that are already going up, betting they'll keep going up. Second, rebalancing. That's just periodically adjusting your portfolio to stick to the plan, like our ruthless coach kicking out the losers. Third, volatility. This is just about how much an investment's price swings around. It's the main risk here. And finally, the Nifty 200 Momentum 30. That's just a name of an index that tracks the 30 hottest stocks from India's top 200 companies. Simple as that.
And so, we've come full circle. For decades, we've all been taught to look for that broken train, the buy low bargain. But now you know there's another way, a mathematical, unemotional, and aggressive strategy designed to ride the fastest trends in the market. So the final question, that's really for you to answer. It defines your entire investment philosophy. Are you built to patiently wait for the slow train to get fixed? Or are you ready to jump on the express?